Hi guys, is anyone out there? Just going to do a quick catch up. We did a Wednesday session, obviously, and I'll repeat. I've got a couple of days away catch up after PPI and CPI, so we get more of a feel. I mean, after what we said earlier in the week, the carry trade nightmare that we had, and then it was all about what the data could say if it could normalize. ISM services did that. We also had yesterday's initial claims, which I mean, like a lot of people said, they never thought that was really a big driver for the markets, but it's just things got so microcosmed. We just needed to find any confirmation that it wasn't blood on the streets, jobs going left, right, and centre. So that was a good set of data to try and normalise things. Obviously, there's a lot of other bigger stuff to come that may reverse engines again, but for now, it may manage to make a couple of the talking heads come out. I don't know if you saw what I wrote earlier. Hello, Rich. Hello, Maxion. Like I said, I'm just going to do a quick run through today. Just make sure everyone's up to speed with what's been driving the comeback. Unless anyone's got any questions, I'll do a quick look at some charts. But like I said, it's very close to what we talked about on Wednesday. So not lots changed. Gold-wise, overnight, physical delivery only 57. So today's little ramp up. Potentially, there's some buy orders into Tuesday that are potentially getting filled. We'll have a look at where we are on the chart there. That could still holding the lows for further downside. Ruled out. We seem to be mid on that. So you guys, hi Lucas, Dr. Maxion, Become Rich, FX Nazir. Have you got any thoughts on the market? What's been going on this week? How you positioned? I mean, this is the 10-year US government chart. And that shows you, we were talking about this on Wednesday. A lot of people had said that the bottom of that consolidation channel there, which was sort of 425, was the signal for the next big leg down, which broke the absolute channel. So that really was a connector. We're into a different gradient here, and that has finished the move for now, but that doesn't necessarily mean, I mean, 3.5 was always the kind of target that I've seen a lot of people have for the rates, but this has put us straight back in here. That's basically taken out the need based on the data at the moment on the 50 basis points immediately and 50 basis points at every meeting. So we're back. The central case now, post services, ISM, and the employment part being okay. The small pullback in initial claims. People who look at that data very, very closely in terms of states showed that the problem states which have seasonal job cuts are all kind of back in line. That's why the initial claims went back down again yesterday. I mean, it's a very volatile series. Nobody really ever trades that week by week. It's more the average look at. The trend has obviously been going up for a number of weeks, the 4-week continuing claims, etc. So it's a good number on its own, but not long for. It's not a great number or have a statistical strength long term for being a predictor. It's more where its direction of travel, and that has been up. It's, the 4-week average is still elevated. How long have I been in trading? Well, including what's 1995, really. Yeah, it started on the buy side as in bonds and equities, and then went on to the sell side with UBS, marketing and trading and a bit of derivatives and blah blah blah, all sorts of things. So over nearly 30 years. How long have you been? Nuclear gaming. Hopefully, you've not got your finger on the button. Yeah. So FX, yeah, FX NASA. We'll have a look at gold in a minute. is Learn Bitnode. You're trading GJ. So what's your opinion on what's happening with the yen and the fundamentals that have happened this week? Yeah, 30 years. Wow. Yeah, battle scarred, hurt. Not much I haven't seen. But, so I've only really been looking at it from the UJ perspective, really, because that's obviously the yen overall. And it'd be interesting to see what happens with the euro and sterling, just because they're hiding a little bit behind what the Fed are going to do. So Fed now, the base case is really back to 25 basis points per meeting. The market is pricing in nearly 100, so 3.5 to 4 rate cuts. So it's a bit on the edge. Is very data dependent. So hopefully everybody's up to speed with the fact of what has been going on is the yen carry trade unwind. Now, there's two sides to that. Obviously, there's the dollar and the yen side. We've been begging the Japanese to start their side and show some strength to their rhetoric, strength to their narrative, which had been sadly missing when they put it up 10 basis points earlier in the year. This time they came out, were really strong, another 15 bips, really aggressive on the JGBs, and said that 0.5% wouldn't be the top of it. So they were adamant. They'd drawn their line in the sand. A lot of the time they've been hoping for the US to show some signs of weakness, but I don't think they made their decision at that meeting based on the fact they thought the US was just about to implode. They may well have held off slightly because the data was only just supportive. So that's the reason why they've now come out and said that they're doing nothing particularly while it's volatile. So the main reason for all the angst, and not everybody is admitting to it, is the dollar side of things. Why? So we've been trading up in the 160s, 150s, but pre-COVID we were at 100. So if the US is on the verge of recession for various reasons, if they were, and as the market was asking for lots of 50 basis point cuts, that was very quickly going to get you back to pre-COVID interest rates. So lobbing off 250, 300 basis points, that means a break-even fair value of 100 for dollar yen. So if you're in there at 150 and it goes to 100, you've lost 33%. So the whole idea of that happening very quickly just panicked everybody out of those trades. JP Morgan yesterday suggests that 75% of it, looking at their prime brokerage stats, looking at CFTC data, etc., suggests that the spot level, so the literal currency levels of UJ, 75% done. But that doesn't mean that there aren't a lot of people with derivative structures in place that they're struggling to get out of. So there may well be further bouts of selling at some point, or UJ rallying. But for now, it looks like we've had that equalizing. We were talking maybe having a 50% rally back into the 50s on Wednesday if that were to start playing out. But we've got big data next week, haven't we? PPI comes before CPI next week. Just be aware of that. PPI tends to be a little bit more tempered, but it will give us a clue on the OER, the estimated rents part of CPI. The weighting in PPI is half of what it is in CPI. So if we were to get a nice, juicy flat number or even a negative on the rents, then the implication for Wednesday's CPI would obviously get things off to the races again, because just as the Fed are trying to say that some of the hawks that came out yesterday, Barkin and Schmidt, saying that think things are in balance and not too tight, etc. If inflation suddenly starts coming down, they are too tight. We showed that in the preview this week. Nominal GDP growth rate versus where Fed funds are, they're sort of neutral at the minute. But if inflation were to come down, that'll bring nominal GDP down fairly quickly. They'll be offside, so they'll need to get moving. Otherwise, they will hit a recession. What we've got here, please share some important tips to help us to get consistency. Do you ever come onto my chat? There was some good chatter today in the market. What Planty? People talking about how they're struggling for consistency, losing, over trading, blah blah blah. So you need to address what your style is. Hi, Bletchley. Um, what what's your setup? What's your strategy? How much are you staking relative to that? Or do you really trust that you've got an edge? Or are you literally gambling? Are you just putting up a risk amount into your stop loss and hoping that it's going to work? Have you actually got proven numbers? And do you gamble on the way down rather than scaling into profits, etc.? So there's all sorts of ways of getting more consistent, but it's having a plan, obviously, widening your knowledge, which is good to see you all here today. Come on to chat, read the previews, ask questions. Fundamentals are important to understand the big moves. There's very little, other than having been aware of the setup that was happening in the fundamentals around the carry trade. There's very little that would have helped you into Monday, or what the potential of that unwind could have been if you weren't all over past and present fundamentals. So I really advise you to keep on top of them if you're not. Really, in trading, you're looking for small edges, improvements on the probabilities of winning. Nobody wins 100% of the time. Certainly not 100% of the time being in and around trading, certainly at short time frames. You've got to be disciplined, have a policy where you're only going in on 5-star trades to achieve that. Super disciplined, not getting angry, not chasing it, not trying to make the chart look like how you want it to be, or the setups. Doing back testing to find something that supports rather than actually systematically looking at the signals that you would use and seeing whether it works. So it's the things that they call confirmation bias. Be honest with yourself rather than trying to make the picture fit. What can help in that respect is making sure you're doing the fundamental and technical analysis 360 degrees. If you can find confluences between both techniques, then you're going to have a more powerful situation. And it may well tell you that your original idea is wrong, which is just as powerful. Not trading something just because it looks there on the technicals, or conversely, you've got a fundamental idea but the technicals don't back it up, is just as important. What is it that you're struggling with in terms of consistency, Nuclear? In the meantime, as I was saying on the UJ, there's been a series of 3 swings that have just kept extending, having little consolidators. We've now done 7 swings. That's a proper place to stop, but it could go to 11. So this could just be a connector. We could have another, that'd be 1, and then another 3 swings down. That's just how it works. It could even end up being double the size. That takes us down to that sort of 128 level I was talking about on Wednesday. Not necessarily having to get to 100. That's just the ultimate inline neutral rate. These things can get overextended, but there's every chance that, all subject to data next week, it can all stay calm. We're going to have a lot of arguments. Just from some of the language from the Hawks yesterday, as I said, Barkin and Schmidt, they're still talking about things being enough time to wait and see, and that things are in balance, blah, blah, blah. That's just head in the sand. They've got away with one, is the way I look at it, from no follow through on ASM services. Now's not the time to double down on prevarication, but to actually all build a case for just starting normalization. 25 bits definite in September would just get everything properly calmed down. And they don't necessarily have to commit to doing more. It's just the fact that they'd be aware with the fact that there are strains beginning to appear. It's this whole data dependency, flip flopping, and ignoring the trend, which is causing the potential risk off trade. We don't really want that. But remember, we've talked about it a lot. There's a lot of seasonality here. In and around August, it's not a strong time for indices. It's a bad time for Russell. We may have a rally, but that doesn't necessarily give us a lot of time to get to a new all-time high, because the second half of September, regardless of whether it's presidential or not, is normally disaster time. Let's risk off. The only other way of looking at this is that NVIDIA reports so late in August the 28th, I think it is. So that may well just drive some renewed sentiment into the first couple of weeks of Sep. and then return us to normal seasonal patterns. But this is quite a deep sell-off for the last few weeks. The ironic thing is that Nasdaq is flat on the week, and S&P still well, they're more or less flat again now. The Nasdaq, yeah, they both just drifted off a bit today, but at open this morning, they were both more or less flat for the week. And given how it started, that's quite an achievement, really. Obviously, I'll have a preview out for Monday. I'm away for a couple of days, but there will be a preview Monday, and then I'll go through it on Wednesday and talk about API and CPI. So if you weren't looking Wednesday, there were a lot of VIX charts, which we'll have a look again at the moment, see where they went to. Geopolitics, we still haven't seen anything from Iran. They're desperate to avoid problems in the region. Probably there's a lot of pressure coming from OPEC countries, I'd imagine, of keeping the Middle East slightly balanced to just on edge. The whole demand implosion from China is not helping oil per se, but they don't really need. Now that they're beginning to lose revenue, Aramco missed on revenue this week. They need to try and sort that out because they've ceded the volume over to the Americans. That wasn't the plan. It's supposed to stay. The oil market was supposed to stay in deficit. So even though EIA this week in oil came out and said that there is going to be a slightly bigger demand over supply deficit, it's not going to affect price very much. 80.23 is their target for CL contracts, West Intermediate. They're trading at 76.85 at the moment, so they're not expecting a huge end of year rally at the moment. We haven't had a lot of clues the last couple of days. There's not been a lot of data. Obviously, there's only been the initial claims and the services. And we slowed down massively as we predicted in stocks. If you weren't here Wednesday, we talked about the S&P. The actual Q2 numbers have been good. They've been up 12% on 80% of stocks. But there's been 10%, 39 or so of just weakened Q3 guidance slightly, which is obviously a slight issue for the market. But I don't think that's enough to derail necessarily the whole positivity, because that is the first quarter that the S&P 493, those not in the Mag 7, have had overall positive results, and that set to continue. So that should, once we get September out of the way, encourage people to be invested into the end of the year. It shouldn't be so, unless there's something in the field again like this carry trade, which seems to be out of the way. Investing conditions should be good. I'm still concerned what's going to happen when the BRICS countries announce the unit in September or October, but we'll deal with that when we get. Trends-wise, health sector was a little bit down, so that's some of the areas where people hide. So that was another reason to just risk. Miners have picked up a little bit. And yeah, again, across the whole of these sectors, there's winners and losers, which is quite useful for overall some of these companies as efficient as each other. So different parts of the consumer sector, McDonald's, Pepsi's, the airline companies in general, say there's a price war going on. All that is actually good for inflation numbers going forward. I keep saying with the state that China are in, there's every chance they're going to export some deflation. If you just came to Chinese numbers today, you would be saying what disinflation, what deflation. There's some seasonal effects today, so their numbers came in with an unexpected bounce. But don't read too much into that. That's just a one-off. Find it. So you've had some small bounce backs, but there's a lot of that is to do with stockpiling, etc. There's not really a lot of underlying demand going on, whether on the export or import side. It's highly likely that comes out again. There's no real change to the inputs that go into the system. Net net, generally a flatlining, if not go down. The biggest issue, keep an eye on it. I talked about it yesterday, and there's always been a lot of ill feeling towards a lot of the data, national data in China, because you can't always trust it historically. And just as they were talking about avoiding a bond bubble, everyone going into bonds because you've got the deflationary setup, interest rates were going to get cut loads and loads. They started selling bonds yesterday to try and make the yields go up. That is just to get people to have some capital losses to avoid them just thinking it's a one-way bet. And funnily enough, the one piece of data that might make it all unwind slightly is a little bit of inflation, and magically they managed to produce that the next day. So I'm not always into conspiracy theories, but I'm not overly convinced about the Chinese data. Very convenient that that came out today. What else did we get? I'm actually working on a note on a site on Cycle, a company that is in AI, sort of the same as ServiceNow kind of thing, where they go into companies and improve efficiencies. And Palantir, you might have heard of that stock. And their co-founder at Palantir yesterday was saying the market opportunity in the service sector is 45 trillion of wages, and that companies like Cycle and ServiceNow and Palantir, they go in and work with people, work with companies on their underlying infrastructure and their apps and networks, and try and deliver efficiencies, and they're producing 30 and 40% improvements on efficiency and actually making them even more marketable as companies. So this is really beginning to happen under the hood. You get all this nonsense coming through about the capex and are you going to monetize it? That is happening all the way from bottom up. The companies need the higher level infrastructure. The AI thing, it's not a fad. So I really, for once, I'm not a massive believer in buying the dip, but any real opportunities you get in this whole AI play all the way through the spectrum of that, looking to pick the right companies, but the overall trend, that is not a fad. We are talking literally a productivity revolution, and it is happening. It's not just a whim. It's not just something people are talking about. Some of these companies are on growth rates of 40% plus quarter to quarter. It's incredible, absolutely incredible. So don't get bluffed out of the tech, and that will obviously read through. This is why there's more of a parallel. Probably people discuss years when they see market events. 1987 was being thrown around on Monday just because of the movement on the Nikkei, biggest movement since 87. That intraday down 12%, absolutely crazy. And the mid 90s, when there was a productivity boost from the start of the internet and mobile phones, etc. And it did take a while, and obviously that was bubble territory. But if you look at people have done a lot of charts about the stock market move we've had now relative to all the great markets that passed. We're probably only 60% of the way along this one, and compared with the 2000 bubble in tech, I think it's the 50s tech Nifty 50, then the two bubble parts of that are yet to happen, and there's probably another 30 to 40% upside from here before that really happens. So there's a lot of doom mongers out there, and it's very easy to build an end of the world scenario. But there's two things: there is underlying productivity there from AI, and the actual productivity figures from the US banging along. So be careful. It's about the 15th major top that I've seen in the last 3 years. So let's not all get super bearish when just on the first shout, etc. So how are we left? US is still going to drive, like the UJ scenario, it's going to drive the rate cycle, obviously. August the 22nd, 24th, that's the big day, Jackson Hole. Keep a lookout for commentary into that. Talking heads probably will be released to start being more positive after that, subject to how Powell delivers it. Comes out of that. It's a 2-day sort of, it's a place where they normally like to release nuggets to the market if they're going to have a change of policy. So really should be saying something. There will be a proper market sulk if that doesn't happen. So the market sulks, as we said yesterday, the setup was going to be either back to the 50 basis points behind the curve, sell off, really big fall to initial claims, in which case panic about there being no rate cuts at all, or something in the middle, which is what we got. And we kind of need things to be bobbing along somewhere between the medium to just enough to scare the Fed to make sure that they do something. We don't need the barking, very head in the sand nonsense. We haven't heard from Kashkari or Bowman or Bostic, who like to lean that way. So it was good to see Gouldsby back on form and taking on the Don, basically saying that they're not political at all at the Fed. We're just looking at economics. They're trying to keep employment high and prices low, blah blah blah. And he thinks that conditions are tight, and any further fall in inflation, that they're too tight. It's bizarre because I don't know if you were watching today. He took the place of the Cleveland Fed guy for a meeting. He's on the reserve at the moment as part of the rotation. So obviously Cleveland didn't want to cut, so he didn't do anything. His own stance has been that to cut, and he may well have voted, but he refused to answer whether he would have done that. He was in his own seat. And he also just came out with some really bizarre rhetoric last week on Friday. Now that it was released back, the GIMP was released back to his own state. Started talking like the real Gouldsby last night on the Fox interview. So I think that we'll start to see a good two-way pull on the talking heads when they appear. I don't know if you watched that interview with Trump last night down at Mar-a-Lago. Only he hadn't been cheated out of the presidency, then the Ukraine wouldn't have happened. Israel wouldn't have happened. We wouldn't be on the verge of the Great Depression or World War III. But don't worry, he's there to save us all. But he wants to have a say in the next rate cuts if he gets in. Trump 2.0 will be the deputy governor by the sound of it. Not good news. Don't need anybody fiddling with independent rate setting. That used to happen in the past, and it was disastrous. We used to have big boom and bust cycles, so we want to try and avoid that. People have had much better models of controlling inflation. If you have inflation controlled, the whole financial market model works. People have confidence in the outlooks, the forecasts, and the sort of the strength of those. The kind of moral hazard is replaced with market reality. That if that goes away, you suddenly need a risk premium to invest in things because you can no longer predict accurately. So that causes sell-offs in lots of assets. So that would not be a good result, however much Trump thinks he's a great businessman. And that's up for debate because he has sort of turned 10 billion into 1 billion. We shall see. So any other questions? I'll just do a quick look at a couple of charts. Get on your way. Great to learn from the beast. Yeah, like I say, also you need to go through a lot of cycles or allow for them when you're doing your setups. It's very easy to get into a mindset that whatever your indicators are, whatever your strategy is, your technical analysis, even the way that you look at fundamentals, nothing stays the same for very long. It's cyclical. Everything is always in the mix. As I say, you're looking for signs of which one is actually in the ascendancy. I keep saying this, but it's key. Don't let anybody talk you out of your indicators, your strategy, just because it's not. This isn't a love-in. This is literally trying to get you to look at the market as a sentiment engine. Everybody is there by definition. They're all putting their trades on. When people talk about it being a bias of buyers versus sellers, it is, but based on sentiment. You've got 20 different kinds of trader, investor, market participant, all doing different things at the same time. And we're trying to see where are the overlaps of the net of what people are doing. That can manifest itself in order blocks, fair value gaps, if you look at it that way, or they are turning points, they are Fibonacci exhaustion points of waves, etc., etc. There can be MACD positives and negatives, either above or below the line. There can be divergences within that. People look at pitchforks. These are all valid. They're all predictions. People look at Ichimoku clouds. They're all at the margin looking at the same thing, just different influences within them. But learn one or two, and then look for confluences from other things. That's the way to consistency that you're asking for earlier. But it's also a way of widening your knowledge. If you look at something and it doesn't make sense, rather than give up, go and look for why is that happening. Go and look for why is somebody doing the complete opposite to what the market commentary is telling me. I mean, remember, news a lot of time when you hear it it's in the past, but often there may be nuggets within that. The known unknowns and the unknown knowns. Remember, I got about this is what we're looking for. That's where the edge is. Trying to find out, working out the timings of things that we know that are going to happen, and also looking for relationships within trends that we hadn't spotted before. A plus B isn't always C. 1 plus 1 isn't always 2, etc., etc. There's normally the opportunity that you've been waiting for is hidden in the data rather than the explicit thing you're looking for. It was good to see people coming onto my chat and asking for the websites, to go and look at the data underneath. They want to see the trends in job data and the components that are driving PPI, CPI, ISMs, PMIs. There's always secondary, what I call secondary data that is there that gives you the clue, and often why is something failing at levels that it shouldn't be. And then you can try and find the relationships. You're not always going to win, but we're only trying to, 51.49, I always say, is a target we can win from. We're trying to get that to 55.45, 60.40. And, dreamland if you can find something that takes you above that and be consistent on, and not totally blow your mind, just to be that successful at that sort of percentage rate. You're living and breathing every kick. So hopefully within this environment, you're finding a nice life-work balance. Even if you're doing this full time, you need to have those moments. There's a few people on asking about psychology today. It's well worth going onto my chat and engaging with them. But psychology is important, and we've talked before. Alex talks about it as well. Health and fitness, massive things. If things aren't going right, often just going away and smashing some weights or having a row or even a long walk. Just clear your head, start again. And often you do best trades when you're walking around, you suddenly clear your mind. You're not looking at financial numbers constraining you. You're literally looking at and thinking about what's actually going on. What have I missed? Are we going to get a retest of that trend? Is that what we've been waiting for? Or is it just going to go straight through? Is that just a falsehood? Is that line been on the chart for too long? It's no longer relevant. Blah, blah, blah. Can you find something that reinforces that level? Yeah, and this is why I'm trying to get people to know about gold. Physical side of gold has changed since January 23. Prior to that, between 1973 and 23, had 50 years of people no longer needing to own gold. The Fed able to manipulate it down to control its weakening dollar policy. Now you cannot blindly sell gold. You can run it to physical. That's what's driving the upside. People need 85% of it. We're about to find out whether they need to use that, whether they can use the same 85% physical that they have in asset ratios for the unit, the currency 40%, which is the rumored amount. If that's going to be an additional 40%, then gold is moonbound. If it's just enough to imagine that everyone's still too short physically to be able to back that, so there'll still be a demand for gold when they announce it. Take that on at your peril. Which brings us back to the whole stop loss thing we just talked about a minute ago. Some people have got taken in by the YouTubers, and you're not seeing necessarily all the data there when you're doing those small stop losses and big percentage effective gambles. You're probably not doing it the right way if you've only got it on in one position in one place. It's not the most efficient way. and a lot of people have gone bust for a long time before that has even worked for the few. So set yourselves up doing something more worthwhile, more thought out, more reasoned, and something that gives you a sane way of playing the markets. If you can be psychologically indifferent as to whether that stop loss or target price gets hit because you know that medium and long term you're doing the right strategy, then you can sit easy with it. You can tweak it, try and make it better. You can control it, and you can manage those stop losses, etc. And you can also be in a position where you're winning. You can scale and learn how to run winners. But try and avoid messing around with the losses. Try and avoid forcing yourself back in just because you've been stop lossed out. Go back, rewind, start again, look for the right trade. This is all the consistency idea. Hi, Shab, Syed, how are you doing? Good to hear from you. Any questions today from you? Right, not really. So I will. Okay. Yeah, let's have a look at this. Let's have a look at this. Maybe next week you plan your trades. Yeah, I mean, it's been a hell of a week, hasn't it? You've had to be aware of the extremities. This is why I say, and this is the reason why I use Elliott Wave predominantly, not because it's necessarily better win rate. It's for the mind. It is for setting up situations, and I look at it as a reverse probability because there's so many little things that negate things being valid, and you can very quickly take things down to a narrow range of possibilities. And it's having the options that gives you an opportunity to trade, and then within that, there are certain levels it can go to. We are in a holding pattern, I think, on lots of markets, and today's super dull, which is why today I was advising everyone to just go and have a beer or find some sun. This is a recharge your batteries day, really. You might be able to nick a few winners. I had a nice win on gold this morning, but I've been away from it working for the last 2 or 3 hours. I'm not necessarily in a rush where it is quiet now for playing, but it doesn't matter what instrument you're in. Have those plans. Just how I'm still set up. This could easily be a double consolidation. We're in the fifth wave up to this hopeful breakout, 2550, 2600-ish, to finish off the move since March, really. Temporary. Then we might have a decent consolidation, but within that, the 5 waves to make that up, I think we're in the fifth wave, or second. I just said the second setup is that we're doing a further correction, a double correction of this. So we had what already looks like a 3 swings, put in a connector, which you can easily have that both ways. I've got it labeled as 5 waves at the moment. I can easily make a case for that being a 3-wave consolidation, in which case we'd be doing another 3-wave move down for the double correction, of which we've done one probably there. And the bearish case at the moment is that we're currently tracing out consolidation, which again is seemingly valid because we've had a 1, we've had a 3-wave retracement, and then within here we've had now to today's high, the 5-wave move up, which is where I've taken off my profit short term. I just want to see how it develops, because this could easily now reverse, and we could go down and test this 2300 region again, maybe tick below it before complete the whole setup. Now, so we could adjust this here and say, look, if that is actually, if we're in a bear setup, where would 1 be? And look, that brings us down to 2350, but allowing for a move to 2260. So anywhere within this lower part of the box bringing us over to challenge the big support levels, wave, pivot points, changes of structure, however you describe it. But the fourth wave that put us into this overall fifth wave, the June the 7th low. We talked about it again the other day, but it is it's 2280, isn't it? 2287.50. Yeah. And even then, if we were to break that, I still think with the nature of the move and the fundamental backdrop, the physical demand that we've got below 2300 have had, that we're going into a seasonal period where even the bear agents, the ones that have got bear positions as members, clearing members of the gold exchanges, they are anywhere between 2,700 and 3,000 for a price target at the end of the year. They don't do that if you're super bearish and believe it. It's purely because they know what's coming, and the physical demand is huge. The physical demand, anyone that's been following this chat knows, is huge for August already. It's been quiet for 2 or 3 days, but I'm anticipating there being some more physical demand contracts coming in. I think anywhere that you feel that there's a big supporting level, that's probably where physical orders are lying at the moment. So if we do come off, it's one to have a look at. And even again, if we're doing nesting and that is a 1 with a sub 2, put in another 5. If we're going higher from here, we'd still expect to have a 3-wave pullback before we go further on. It'd be a shallower 1. So I want to see how it reacts into pullback and if there's a momentum trade to have if it breaks down. So I'm in a holding pattern at the moment on gold, having ridden up this current 5 waves. Anyone else playing gold at the minute? Remember, for entries, I like to just go and check to see where the Bollinger Band demand is. At the moment, we're in the sort of middle of the bands. Remember, we're focusing on being between the 2 reds or the 2 blues. And currently, we've come out of that uptrend. We're consolidating on the 15 minutes. So there's no real trade at the moment. And the mean reversion of Bollinger Band suggests that at some point soon we're going to go through the lower side. So unless we go into a walking up scenario, there's no signal at the moment. So yeah, that suits 24.23 would be for anyone that plays mean reversion of Bollinger Bands. That would be an entry, or get it on the pad time, because 23 is down here, just the other side of that 2 standard deviation. Where is it? Yeah, it's actually just getting into that band. So yeah, it's interesting. What I do is at some point it will cross this lower line. It's just what happens to the volatility of it in the meantime. So it can get walked up, but if we're coming down to it, then the momentum, the vol turns down. So you meet it a little bit lower. Like I say, there isn't a signal there necessarily at the moment using that. DXY, we've been talking about, are we going to get this one more leg down, or is this actually the 5 waves down to give us this 5 and 1 here, in which case we've got a potential for a deeper buy on DXY before it turns down again. Now, at the moment, obviously, we've put in sequential highs, so it's suggesting that is a connector. Let's get rid of that. So for me, I look at double extensions as the first instance, which is telling us that 103.94 is a potential. Spot 618 to 90 spot 618 to 1 is a range where I'd expect the second leg to finish and not go much more than what spot 618 or into something bigger. I have to reevaluate. There is, even though we've been in this long-term downtrend and it has been doing 1, 2 tests, like I said, there is an alternative, which I don't have it's a very strong case at the moment, is that we're already, since the ultimate low that we had, we're already in a pattern that's about to go up. What do I mean by that? There's an argument that the mid-year low last year is potentially um, a turning point, in which case we're already we're into a one and we're nesting to the upside. I think that is, I have that in sort of 10 to 20% percentages, whereas I think that the main setup is that we put in an ultimate low to finish this, what is really ABC pullback before we then eventually go higher. That's probably some kind of bad risk off event. But remember, there was a dollar smile that I talked about months ago, where things can start going positively for the US, attracting money in which case you can have positive correlation between the dollar and equities, bonds, etc. Gold. This is why someone was asking the other day about DXY correlation with gold, and it's really real interest rates, and obviously interest rates do impact the currency, but the actual correlation with DXY is minus spot 1.5, so an inverse relationship, but hardly any at all. You'd want that to be sort of minus spot 8 to 1 to be able to say that there's an inverse relationship properly with gold and the dollar, which is quite bizarre, isn't it, given the fact that it's priced in dollars. Name that you need to have that in the back of your mind, which is why a lot of people get caught out. They think that it has to go up because the dollar's weak. It doesn't. And now it can do whatever it wants based on physical demand. So mixed picture, as I say, short term for the dollar. My bias is that we go lower. It's just where do we put in the where do we put in the turn? I do think that we are just consolidating as a fourth wave in this bounce back. There's one more bit of downside. Maybe that comes next week when we have the data. Like I said, if that comes in between the 25, 50 bips, then we'll have a bit of weakness, I think. And this is why I say it's mid-fundamental, it's mid-technical, because we know, as I've said, it could be halfway to the next stage of rally. So that again sets you up for slightly less dovish data than the market anticipated. And then we're moving towards Jackson Hole, where we're anticipating that actually topping out. I don't think they can avoid, unless the data massively reverses, I don't think they can avoid starting the process. We started off with this one, didn't we? 10-year. It's come back into channel, but is that going to be a kiss goodbye? This is a classic. If didn't have the trend lines on, you wouldn't really be thinking anything about that level, but it's obviously it's hit it and come back out again. They call it a kiss goodbye sometimes, so that might cement this move down to 3.5 that we're looking for. Again, that would be data dependent. Is anybody playing Euro Canadian dollar? Someone was asking about that the other day. I'm generally buying it. Has there been any Canadian data today? Employment change. Okay. So that probably came in a bit more hawkish than the market thought. So the setup, a lot of people are saying again, fundamentals, Macklem and Canada, and they've had the data generally in their way, been cutting rates at a quicker pace, detached from the Fed and saying that they want to continue doing that. And you should be a lunatic if your currency is called a loonie. But a little bit of positivity for the Canadian dollar. It's just bounced a little bit, I think. um, which is that red candle. So the net setup has been that the Canadian dollar should be weakening, that they're going to cut rates quicker than the euro can cut rates. But the euro is really on hold until the Americans do something. So a lot of this, we have to be very careful about getting too driven by any one particular central bank. But Canada have detached themselves a little bit. Swissies have been detached with their rhetoric. They've got other issues going on, and Australia again this week mentioned that they would raise if they had to. They don't want to, but they up their inflation guidance, etc., etc. But in the main, most countries are on hold relative to what the dollar's going to say, and that is what causes lots of issues at the start of the week. But remember, it's a relative bet as we go along, so don't just get. It's difficult to, from a fundamental view, across just looking at one country on its own. You've got to put it in the whole, in the mix. Which again, sterling, dollar, we had, again, we thought that we were bottoming out here on Wednesday, didn't we? Tuesday, Wednesday. Could we get a tiny bit more low? We weren't sure. Again, it's probably done enough. We're still with, it's got us into this spot 6181. We were saying, will it come here? The fact that we've, it's very important now, isn't it? What levels hold? But you've got a stop loss again at 126.60 if you want to play the positive. But it's hard, we're challenging 50-day moving average again. But what is happening in the US dollar? It's going to drive the fundamentals. There's no real scope from any of the GDP data. In fact, most of the sterling data this week would have stopped them doing the cut that they did last week. So they did cleverly take advantage of that air pocket of data, because it's going to be mixed for a while, and they're really looking for the US to get going so that they can come down in lockstep. But again, if the US were to come 50 bips, the Bank of England wouldn't do more than 25, unless it was an absolute road crash. So again, that is suggesting that we should be around or about to start a wave 3 up. If you know Elliott wave or you follow me, you know that is going to be the most explosive wave. So it is kind of there's going to be some detachment between sterling and the dollar again, and we should at some point start looking at 130 again, because that was the previous one high. So my bias stays that way for the minute. We've been looking for a low. We've got another excuse to try it over here. We mentioned UJ at the start. Again, we need more evidence. Probably need we need a new high to convince us that we've got at least double the pullback that we've had already. I mean, that looks more like 3 waves consolidation, maybe a 1-for-1, 3 waves again. What does that look like? Oops. Fat finger today. So yeah, as we said on Wednesday, a test of somewhere around 148 to 150 looks reasonable to assume, even if it's going to go back down again. And then from there, spot 8 to 100, wherever that's selling off from. Remember, it dropped 20 basically, didn't it, to the low? So that gets you to that 130, 128 idea. If we go into a double correction for whatever reason, so we just need to see how it reacts on the next move up. That might develop this into a 5-wave start, which is at least a zigzag. That's 535, or it's 53535, and a proper move up. But we need fundamentals. We need a fundamental change to get a new all-time high in, and at the moment, I don't really want that to happen because that would be a massive risk-off moment. Again, the other way, there'll be no rate cuts coming. Well, I suppose you might get the draw. It's that there are no rates, but it would mean that there'd be plenty of growth going on. So we moved this to super cycle sell-off just because it was 30%. COVID short term, I mean, it's just 3 weeks of absolute carry disaster unwind, but let's try and have a bounce. Again, this could end up being a connector to a repeat sell-off, given how elevated it still is. So you have to be cautious. It has regained the 50-day moving averages, and it's been hugging on to that for a while, so we have to treat that as the top or bottom, subject to how we're reacting. The right on it, we just obviously this is the key, so I'd advise no trade at the moment because it's hard to tell what the fundamental driver is, and there's still unwind going on. I mean, there are actually some good underlying results for Japanese companies this week. Had a small bit of profit, mainly driven by buyback, I think. So I'd have to say Nikkei and Topics are just for the minute, leave them alone because there is danger that we're just doing a connector and they've got huge potential downside if that's the case. Larry Keane, I'd love to do an account giveaway, but I haven't got any power to do so at the moment. I'm speaking to Alex on Monday. Excuse me. Hopefully, I haven't spoken to him for a while, and I'll try and get some giveaways for the show. But get an information giveaway. What more do you want? Excuse me. Got a frog in my throat. All right. The DAX, similar situation. We've moved over the whole consolidation because it was extending. It has put in what looks like a cathartic low. I do like those. I like the big impulsive 5-wave finishes into V shapes, into absolute MACD super low. You know, that's minus 200 on the MACD into a low with lower sequential lows. Like it is. It looks like it's over. We've bounced up. But again, it's how we react from here. Because we've had a three-wave rally with higher highs, then a low, and then we've put in an even higher high. So that often suggests that might be in a consolidation wave. So we need to see how that develops. But again, it's gone above its 50-day. Will it help you? You can have that as a stop loss. That's a decent place to have a stop loss. Or within this structure, where will it be going back down again? Really, at the bottom of its consolidation range there, 17,400, 17,350 maybe, just to be outside the true range to make sure it's a genuine new low. So it's a couple of percent away if you're swinging. Might be too much if you're short term. So 50-day moving average if you're doing short term trades. But you know, a lot of this is all in, as someone suggested a minute ago, we are quiet period on hold for next week. Nasdaq that overextended on Monday. This is the weekly view, but it's just sort of back to returning into its own this 5-wave channel we've got in there. The primary level weekly channel still got the chance for the all-time high. It's just that doesn't necessarily have to be there. The suggestion is anywhere in this channel, and timing-wise, that may well be that we, it's the end of year rally that takes us to that. There is a potential, I said, around Nvidia to get this short term on an absolute tear up. But at the moment, I'm just slightly concerned about what happens if we get to 50%. That's what we were talking about on Wednesday. With a lot of these things, 50% look like equal legs on a lot of these for a consolidation wave. We need to get those out of the way. what we're talking about. Yeah, use that one, I think. So in this channel of wave fourness, we went through equal legs, and then what we do on the bounce back of that whole thing. Where is the 50% retrace? And that is 19,000. I'm kind of halfway back to that from the ultimate low. So this, so far we've looked at that, and it does look like it was a leading diagonal fifth wave of 5 to finish that. So it's still a valid bullish movement up, but it's got a lot of consolidation overlapping waves in it. So you must, by definition, when you see that, you must allow for the fact that that could just be the first leg of a consolidation up. We've put in a 3-wave down, and again, we've had a 5-wave short term in. So that is a valid point for this whole rally to have stopped. And we came off yesterday and into today. So it is valid that we may be putting in at least a connector down before we go higher, or it might be starting to turn completely. So tricky situation in that. What is the best way of playing it? I said the relatives at the moment, it's banging between 19,000 and a retest of the lows. You could put a short on with the overnight top, but at the moment it's kind of no man's land. I want to see more indicators. So look for some short term buy entries subject to your own indicators, but for the moment that's been held by 50-day average, 50 period moving average, isn't it? What's that? Keep doing that. Hours, 24 hours. That's its effective daily average, 24-hour average. Yeah, I kind of want this thing to dig in and go again. Just it fits with fundamentals on the reporting side that have come out. Lots and lots of under the hood strength in the AI tech, and Russell 2000 being in a negative for the start of August. You'd expect this to outperform in normal conditions. Just have we got normal conditions? It's going to be tough until we get some more data next week, probably, to get anyone to commit big money to it. So holding pattern again on Nasdaq, really. Remember we talked on Wednesday what would happen to this. This doesn't happen very often. Normally signifies you're at turning point lows in the S&P 500 when stocks trading over the 200-day moving average go negative. We've obviously bounced back again. We're holding on. It's a bit of a flip-flop this week. That's looking for direction. Again, we bounced off what is a valid consolidation wave, but it's not guaranteed that we're not just putting a connector in. This 4th wave can go all the way down to 4,100 and still be valid. We're only halfway in that, so we have to be careful. There is still potential for more extension. It's becoming, the S&P 500. There's a valid 4th wave stop here. We've had the double incidence of negative 200-day moving average relative to its zero line. But these things, when you have down market like we had here back in the end of last year, this is the September sell-off to October low. We started going negative in August, like we just have here. We had rally periods where that didn't really get much above blue again. But once it turned, it took a few days And when that trend started to establish, we're into a big third wave. So to know that we're in the fifth wave, we'd need to see sequential days of that 200-day moving average going into the net positives. So that is number of stocks. It's whether there's it's the 50 is the dividing line. So you're getting back into the sort of 55, 56 kind of region there. And here we're in the sort of 48, 47s. But like I said, once you get that trend established, you're normally in a longer sell-off. So it's quite a useful way of looking at it, because that's a long time to see a trend change over. It's really quite important. Again, we said volume picked up again back at these important levels. This fourth wave in April and beyond on the rally was where we had all the volume. It's picked up again. We'll come back to that. Is that buying the dip? Did that suggest that we have finally found where the turning point is? We've bounced off it, and then be interesting what happens. I said you can get momentum into the market. The volumes have been quite low, other than 50-day moving average. So that again is going to become an important test. 54.50 if you get back up there, and that just from your eye, you can see that is again around a 50% retracement of the current move. So keep in mind, 54.50 is going to be a big test to the upside. Not much point saying anything about the Dow other than it's a microcosm of the same thing. That's very much looks like a clear three waves labeled two with an impulsive finish again. And it's a case of, are we nesting or are we just doing a three-wave consolidation? And again, there's a couple of little subwaves in there that might mean it's done a finishing five waves. So if anything, on the evidence what you're looking at, you would play shorts with the current move high as your stop loss. But that's nothing other than just being technically looking for reasons to trade. I prefer to see it play out to a more significant level. FTSE no change from Wednesday. We said it had started bouncing off what looked like, again, an ending point to the move. Very much bottomed out into those 2 days of Monday and Tuesday. So that suggests we had quite a bit of momentum going into that low, even though it was a doji day on Tuesday. So again, until this breaks, either way, we don't really know. That's midway. I suspect it is the first of a few waves that might have a little bit of consolidation, but I don't see any way that the FTSE holds up if the other markets come down. I mean, it's kind of building up for a test of this 200-day moving average, isn't it? Really, if we're honest. And let's leave that in place for the minute. Let's just look at this current setup. Yeah, I mean, spot 618 and a new low. It's very close to the 200-day moving average. And that also is close to the one spot 618 of the original one for one that we were looking at, is whether this was an expanded flat when we looked at it on Wednesday. So yeah, it kind of feels like there's a pullback still to finish this off. But I like to be bullish in the first instance, so I'll give it the benefit of the doubt until we get a little bit more direction. But if you get a negative market, I wouldn't put you off hitting FTSE short term. It looks very much like there's a bit of confluence down here, and that fall might just have to drop a little bit lower. Brent, we talked about. That's obviously, again, a cathartic sell-off. Probably puts the ending point in for what looks like 5 waves down, and we're consolidating. A very bearish outlook for demand and oversupply potential in uh, in oil. So this could well be look for a retest in the 70s. It's just whether how far this thing comes back. Yeah, which effectively is that needs to be a tiny bit higher, doesn't it? So 50% retrace from there. Is here at 81, spot 2. So very much look like 80 to 81, possibly look to put another sell on. But I wouldn't want to be buying this particularly at the minute because that's done enough already to have finished the rally up. I don't trust oil at all at the minute. Usual friends, the VIX, we're looking for it to come back into the 20s. It's been sat around 30. We'll have a look at the channel. Back into the 20s, 16 to 20, and it'll be rally on again, super calm down. Obviously got up here because people were buying protection. When they buy puts, that's the implied volatility that they're paying hidden within the model. The higher the price, the higher the implied vol. And then the market makers, if they see demand, they'll just make their vol market even higher to make the price higher. And the idiots will just be paying it. And that's why we had the breakout. Bond market volatility, that's calmed down a little bit. We said we were flip-flopping 25 bips at the front end. And the long end, as we've seen, has had that trend channel challenge, but that has now calmed down. Flip-flopping, we're on hold. So the volatility is dropping a bit in the overall bond market. Sorry, that's dropped off again. Volatility indices, look, VIX breaking out. It's really eased off. We're on the verge of being back into buying territory in the 16-20 level, buying equities, that is. Bonds, the volatility in that's because you've been having the curve flipping round. So you've had ups and downs all over the place. The volatility has gone up. That is the VIX itself. Look, the channel needs to re-enter around 15, 16. That's the down channel that we've been trading in when the market's been positive. So you'd like to think it needs to come back down there. So we're still elevated. That's why people are still a little bit fearsome, just levels outside the trading channel for the last 2 years. But I'm sure it won't take much more positivity to get that back down. But again, this is all holding pattern, isn't it, for next week? And that does it really for me. If anybody else got any questions before we go? Go and enjoy your weekends, etc., etc. Forex from Kerala. Hello. Are you on the beach? Kinrich, ACG, Diamond Geezer loves. Thank you, sir. I hope that was useful. If you've got any questions, put them on my chat, or next week I'll be doing this Wednesday and Friday again. So hopefully have a good start to the week. I'm available on my Discord but I'm not in a place where I can do a live show, so I'll do it on Wednesday. Be profitable, be thoughtful, don't just trade for the sake of it, have a reason, protect that capital. And the best of luck. Thanks for joining, and we'll speak soon.